Because of those secular factors, I think productivity, to a certain extent, was a function of finance. I mean, when we go way back in terms of mortgages and securitization and so on, leading to access to housing and so on, you can see a certain element of productivity in finance itself. As a matter of fact, some papers have talked about maybe 0.5% over a period of time. And now with finance played out and interest rates as low as they can go in many countries at least, then productivity there is certainly changing. And then there's the Gordon thesis of low-hanging fruit and so on. But
Robert Gordon, the economist from Northwestern.
From Northwestern. But the counter is simply that it takes a long time for technology to affect productivity, certainly in medicine and other areas, and so let's wait and see. But we have seen productivity in the U.S. at a flat line basically for the last 5 years, and that's becoming a long-term trend. And I think the secular forces of debt and demography. Older people do not demand as much in terms of goods and services. Healthcare, yes, but they slowed down an economy simply because society is getting older. You see that in Japan. Look at Japan as a petri dish for the last 10 or 20 years, and not all of the factors are the same with immigration and so on. But you know, to the extent that the global developed world is aging, then that presents a problem for capitalism and for growth.
So that's a commentary more on structural reality than it is a criticism, if you will, or at the very least skepticism of what this administration and this president might accomplish.
Yeah, I think so. And when you speak to the administration, you speak to fiscal policy and potentially monetary policy with the appointment of governors and presidents, and ultimately the head of the Fed in a few years. But yeah, I don't necessarily criticize monetary policy. It's done what it's had to do, but I think at a certain point they crossed the line and went too low, even into negative territory. And I think ultimately that low interest rates and negative interest rates have a very destructive force in terms of capitalism, because certain business models, long-term established business models like insurance companies, pension funds, even banks to a certain extent, you know, have liabilities that that require a return on investment and a return on their savings. Even mom and pop in Des Moines require a certain interest rate to pay for education for their kids or for retirement or for health care. And to the extent that savings doesn't provide an attractive return because of low interest rates, then a balanced capitalistic economy becomes potential to misfunction.
I've been an observer of finance for some time, not as long as you. I remember as a college student hearing about what the mortgage bond market was doing for housing. And I've seen financial innovation, good and bad, come and go as you have. What do you mean by finance is played out? Is that to say that that good ideas, I don't know what they mean. Tell me, because I'm thinking it could be all the smart people are going to Silicon Valley. It could be the financial regulation has stamped out innovation. It could mean something else.
Well, you know, innovation is changing finance and changing investment, certainly with algorithms and you know, the substitution of a machine for a person. There's no doubt about that. But when I say that finance is played out, I simply mean that the price of credit is basically as low as it can go. And you know, common sense and economic models would suggest, as central banks have suggested for decades, that the lower the interest rate, the greater the push in terms of you know, economic growth as capital markets appreciate, and the trickle-down wealth effect, you know, leads to an element of growth. But when interest rates get so low, then things may go into reverse. Money may go into a mattress as opposed to an investment. And certainly if you were an investor in Germany or a saver in Germany with the ability to hold euros as opposed to put it in a bank and be assessed 50 basis points, you would see the beginning of the reversal of the process where lower interest rates in finance plays out and begins to move in a direction that is negative as